Why is there pressure on the exchange rate at this point? And the explanation lies in three significant external developments, as well as certain domestic characteristics of our economy. Despite the fact that we have made some progress in stabilizing the economy, we have been hit by exogenous, external developments which are exerting a lot of pressure on the economy as a whole and the exchange rate in particular. And given the nature of our economy, we are vulnerable. So let me try and explain that a little bit more. So what are these external, exogenous factors that are putting pressure on us? One is the increase in interest rates in the United States. The normalization of monetary policy after the very unorthodox, unconventional monetary policy that was adopted in the wake of the global financial crisis in 2008. So now we are seeing the normalization both in the US and Europe, and to a lesser extent in Japan, but particularly in the US, where interest rates are going up on a sustained basis. There have already been 3 interest rate increases this year, and there's likely to be a 4th in December. So what is happening because of this increase in US interest rates is that large amounts of capital is flowing out of emerging markets back into the US. In the wake of the global financial crisis, money flowed out of the advanced economies, including the US, into emerging market economies, and we also were able to go out and borrow significant amounts of money from capital markets because there was all this money that was being created by global central banks, as well as other savings of companies and people in the advanced countries, which was coming to emerging markets in search of higher yield because interest rates were so low in the advanced world. So that we had a propitious, a favorable external environment at that time. But that has now shifted dramatically, and money is now going out of emerging markets, including Sri Lanka. We have seen some money, fortunately still not a major flow, but there is money going out of the government securities market. That is, foreigners have invested money in our treasury bills and bonds, and a little bit of that money has gone out. In addition, some money has gone out of our stock exchange. And that is putting pressure on the exchange rate because for this money to go out, there is demand on US dollars. And when you have additional demand on the US dollars and our supply is limited, the exchange rate depreciates. So that is happening. So that's one factor, the normalization of monetary policy in the US rates and the shifting of capital from emerging markets back to the US in particular is putting pressure on a lot of emerging market countries, including Sri Lanka. The second factor relates to geopolitical tensions. The US-China trade tension, I think you could almost call it a war because the US has now put $200 billion worth of tariffs on the Chinese, and the Chinese have retaliated with $60 billion. So that's creating uncertainty in the global economic environment. In addition, the US-Iran tensions are creating uncertainty, particularly in the oil market. Thirdly, the geopolitics in the Middle East as a whole, with a group of countries allied around Saudi Arabia on the one hand, and others allied around Iran, and the tensions between the two, again, has elevated tensions in the geopolitical context. So that, and when you have elevated tension, uncertainty at the global level, brought about by factors like the trade war, like factors like uncertainty in key oil producer countries, and tension in the whole of the Middle East, what happens is that money moves to what are termed safe havens. What are the safe haven currencies? The main safe haven currency is the US. It is the currency which is the reserve of the international financial system. So when you have elevated uncertainty in the global context, you have money flowing into these safe havens. So money goes to the US. The yen, the Japanese yen, is another safe haven currency, and to a lesser extent, the Swiss franc. So money goes out of emerging markets into these safe haven countries with these safe haven currencies. So that is another pressure that is leading to pressure on emerging market currencies, including the Sri Lankan rupee. The third pressure, the exogenous pressure over which, all these are things we have no control over. The third pressure comes from the higher oil prices. Countries which are net oil importers, when oil prices increase, then there is pressure on their external account. Again, their money that is going out to pay for the oil increases, and in relation to the money that is coming in and is available in the country. So that again puts pressure on the exchange rate, and Sri Lanka imports all its oil. So these are the three exogenous factors which have all come together and are a major reason for the pressure that we are seeing on the Sri Lankan rupee. Despite the fact, of course, I would say this, but you can independently also take a view on this, despite the fact that we have made some progress in stabilizing the economy in terms of improving the frameworks for making macroeconomic policy and trying to institutionalize those frameworks. Despite that, these exogenous factors are too powerful, and we don't have the capacity to withstand them without some pressure on the exchange rate. I must hasten to add that this is a controllable situation, but there is pressure and the exchange rate has depreciated. So what are the countries which are most vulnerable when you get these kind of exogenous factors, when money starts to move away from emerging markets back to the advanced countries? The countries that are most vulnerable are those with current account deficits. That's deficits in the current account of the balance of payments. Because what that means is the money going out is more than the money coming in, and one has to borrow to fund the gap. And because you're exposed to borrowing in a context when global interest rates are going up, then the risks associated with your economy go up, and that creates pressure. And so as we are a current account deficit country, we have seen the rupee under pressure. So you have these three exogenous factors over which we have no control, and on the other side, the fact that we are vulnerable as a current account deficit country. Of course, the fact that we are a current account deficit country is our doing. Nobody has made us into a current account deficit country. The fact that for many years we've had wrong economic policies. We have allowed our exports to come down from 33% of GDP in 2000 to 12.4% of GDP in 2015. At the same time, we went out and borrowed large amounts of money, a lot of it on commercial terms, and much of it went into projects which are not giving us a decent rate of return. So when you're in that situation, you end up in the kind of position we are in now, which is a very vulnerable position. So when the world economic situation turns against us, we are not in a very resilient position to counter that. So that is what we are being confronted with today. So if I can move on now. So this is, I've talked to you about the exogenous factors, the domestic configuration that makes us vulnerable. Then finally, let me say, people say, why is it that the central bank isn't defending the rupee more aggressively? In the past, we used to defend a particular rate. Why is the central bank letting it slide? So let me give you two examples of what happened in the past from which we have to learn lessons. So in 2011, 2012, the central bank spent 4.2 billion US dollars. Our total reserves are about 8 billion at the moment. We spent $4.2 billion to defend the rupee in 2010, 2011, and in the end had to depreciate by 13.5% anyway. Equally, just to show that this is not only one political party that does this kind of imprudent thing, in 2015, under this government, the central bank spent $2.1 billion. And then, in the end, the rupee depreciated by 9% anyway. So trying to spend large amounts of our reserves, to deplete our reserves on a large scale, to defend a particular rate, is not possible. In the end, you end up with a double whammy of highly depleted reserves as well as a depreciated currency. For that reason, we have been pursuing a more flexible exchange rate policy, which has been more determined by the market, but at the same time, we have spent some money to try to smoothen, to reduce the pace at which the depreciation takes place. So that's essentially what we have been doing in the central bank and the monetary board. But what are the remedial measures? So we haven't just been sitting back and saying that these things are beyond our control and nothing we can do about it. So what has been happening? One is that, if you remember, the duty on gold was increased. The gold imports in last year and at the beginning of this year went almost 90 degrees up. It almost doubled. Actually tripled. It went up from about 250 to about 600 million last year. And in the first 2 months of this year, gold imports were going at a rate which should have gone up to $1 billion. And why that was happening? Because we had a 15% duty, we had a duty-free access of gold imports into the country, whereas India had a 15% duty. So smugglers were basically arbitraging the duty differential, importing vast amounts of gold into the country and smuggling it out to India. And that had a very deleterious impact on our balance of payments. So that was adjusted by the duty being taken up to the same level as the Indian duty, and we have now found that gold imports have come down very significantly. The second issue has been motor vehicle imports. There has been a dramatic improvement. Almost 2/3 of the deterioration in the trade account this year. The trade account deteriorated from, for the first 7 months, deteriorated from 5.3 billion last year to 6.4 billion. And of that billion rupee increase, 2/3 were due to motor vehicle imports, particularly small vehicles. So the duty on small vehicles has been increased. And just yesterday, the margins have been introduced on LCs. 100% margins have been introduced on LCs for all motor vehicles.